Welcome everybody. We're going to do a high-level overview of the CFPB's TILA RESPA Integrated Disclosures Rule, or TRID, which we've come to call it. So let's get started. So first, really, who is the CFPB? That's the thing we need to talk about first. The CFPB, or Consumer Financial Protection Bureau, was created in 2011 as a result of the Dodd-Frank Act. They have supervision over banks and non-banks, which is new. And their enforcement authority extends over TILA, Truth in Lending Act, and RESPA, the Real Estate Settlement Procedures Act that we're much more familiar with in our industry. They also have a real goal to actively inform and protect the consumer. A lot of the Bureau staffers will say, it's in our name. We're a Consumer Protection Bureau. They extend beyond the enforcement actions, though, and handling the law, and are really going to work to improve the mortgage closing process. They have efforts underway to improve the process right now. But I think most importantly, their enforcement actions have extended to banks, mortgage bankers, mortgage and service providers of all kinds, and of course, we've seen it with realtors as well. So definitely changes there. So the changes are big, and TRID is something that's part of our vernacular now, and there are lots of things changing. So buyers, sellers, realtors, lenders, even title companies will all see new forms, new disclosure forms, and have new terminology to grapple with for the first time in years. And that also includes new timelines for closing, which is probably the big change. Then we have the TILA RESPA Integrated Disclosure Rule, which is intended to help consumers understand their mortgages and future financial obligations, and to help them better shop for their loan in the beginning. TRID is also meant to help prevent surprises at closing, and should serve to have more informed buyers at the closing table, which is good for all of us. So moving on to the effective date, most of the provisions apply to applications received by a creditor or a mortgage broker on or after now October 3rd, 2015. So we have to think about the pipeline and the loans that are, and transactions that are in the pipeline now versus what's happening afterwards. So moving on to coverage, there's a lot of confusion about which loans will be covered and which ones won't. The new rules apply to most closed-end consumer mortgage loans. It doesn't apply to home equity lines of credit, when most of them aren't subject to RESPA anyway. And it also doesn't apply to reverse mortgages, which continue to be subject to RESPA. It also does not apply to mortgages secured by mobile homes or by dwellings that are not attached to property. If the mobile home is real property, the rule does apply. So there is a fine distinction there. Creditors that make 5 or fewer mortgage loans in 1 year are also exempt. And loans that are not considered consumer loans, such as commercial or business purpose loans, are also out of scope. So let's move on to terms and the new terminology. The lender is now typically called the creditor under the rule. And the borrower is called the consumer, which is really new terminology. We tend to think of them as buyer and borrower alike, but now we're talking about consumers more often than not. And then tolerance means variation now. So the new term variation applies to the variation in fees. We haven't really seen that in the past. And then probably the most important is consummation. We tend to talk about closings, but lenders under the new rule will have to really figure out when the loan is consummated under the new rule. And that's when typically going to be defined as when the borrower signs the note. Okay, so moving on to the definition of business day for the closing disclosure delivery. It's very important that we understand that there's been a lot of talk about the new 3-day rule, and really it's the 3 business day rule. There's a big difference, especially when it comes to holidays and such. So when providing a loan estimate to the consumer within 3 business days of application is the rule, a business day is defined as a day on which the creditor's offices are open to the public to carry on substantially all functions. The waiting period between the loan estimate and the consumer's receipt of the closing disclosure, and between the closing disclosure and closing, is defined as all calendar days except Sunday and certain federal holidays. So very important to know that there are different definitions of business day for the loan estimate and then those that come in later in the transaction. Okay, so a big part of this new rule is really the new disclosure forms, the loan estimate and the closing disclosure. Bob, tell us about those forms.
So the new loan estimate will replace the good faith estimate, and the same basic rules apply. They must deliver that loan estimate within 3 business days of the application. It will be replacing, as I mentioned, the good faith estimate and the initial truth in lending, which was customarily delivered alongside with that today. The loan estimate is going to itemize the loan terms, cash to close, closing fees, loan characteristics, and it will be using a plain language explanation so the consumer can understand the terms. As I mentioned, it must be provided within 3 business days of the loan application. And the summary of the key loan terms will be provided through the estimate for the loan cost, and it will include cash to close. The idea is to promote comparison shopping so that they will have a level playing field when comparing lender to lender.
Great, so big changes. So who's actually providing this loan estimate to the consumer?
You know, that's a good question. The creditor or the loan broker may prepare and provide it. However, the creditor is ultimately responsible for the loan estimate, but both the accuracy and the delivery.
Great, and so who provides the closing disclosure?
And again, the closing disclosure will come from the lender. It will be replacing the final TIL, or truth in lending, and the final HUD-1 settlement statement that we're accustomed to receiving today for closing transactions. The disclosure will include, again, all the loan terms and the fees associated with the closing, and also a list of loan features.
Okay, so it really is the lender's responsibility in most cases.
Yes, yes. The lender does have the option to allow others to deliver it, but like the loan estimate, the creditor or the lender is ultimately responsible for the accuracy and the delivery of that document.
Okay, so that's great. So what about the seller? We don't want to forget them. Who delivers the closing disclosure to the seller?
Good, another great question, and in fact that's a little different twist because the settlement agent will be responsible to prepare and deliver the closing disclosure to the seller. And it will include the normal items that we would see today in a seller's transaction relating to the various fees that one would associate with the seller's transaction.
Okay, so another major effort behind the CFPB's work is to make sure that borrowers and home buyers get to shop for their services. So Bob, will buyers still be able to be permitted to shop for services from among different providers?
Yes, the rule also provides for a written list of providers. The model forms H-27B and H-27C. If the consumer is permitted to shop for the settlement service, the creditor must provide consumer with the settlement service provider list, or SSPL you may hear it referred to. There must be at least one provider for each service, and it must be on a separate sheet of paper provided at the same time as the loan estimate.
Okay, great. So here's, I guess, the big question, and this is one that's all hard for us to really grapple with. Is the HUD-1 settlement statement that we've known since 1974 through various variations, is it going away?
Not completely. The HUD settlement statement will be replaced for most consumer residential transactions. However, it will still be used for specific transactions, as you mentioned earlier, for reverse mortgages. But ultimately, it's up to the lender to make that determination. As a settlement agent, you must follow the lender's instructions and guidelines and prepare the appropriate document at their request and their instruction.
Right. So now there's a lot of this that revolves around the changes in timing and delivery. Dawn, can you tell us about the timing and the delivery of these new disclosures?
Sure, Marvin. Timing is a really important component of this new rule. The rule now imposes a mandatory waiting period to permit the buyer time to review their final loan terms prior to going to closing. So as Bob mentioned, the loan estimate has to be provided to the borrower within 3 days of application. And when providing the loan estimate to the consumer, a business day, as Marvin mentioned, is defined on that day in which the creditor is open to the public to carry on substantially all of their businesses. Now, for the closing disclosure, there is a different 3 business day rule, and a distinction is made with respect to the timeline of delivery and receipt of the closing disclosure. So the creditor must actually give the closing disclosure form to the consumer so that they receive it at least 3 business days before the consumer, before consummation. And as Marvin mentioned, most lenders are defining consummation as the day that the borrower signs the note on the loan, the date they become obligated on the indebtedness. So they have to receive it 3 business days before that consummation. Now, if the creditor delivers the CD to the consumer in person, meaning they physically hand it to the consumer, then it's 3 business days from that. So if they deliver it on a Tuesday, you count Tuesday, Wednesday, Thursday, and Friday is the earliest date that you can close. If they put it in the mail or FedEx or send it via email, this is called the mailbox rule, then it's presumed to take 3 days to get to the consumer, and then you count the 3 days. So if the lender puts the CD in the mail on Friday, the consumer is deemed to receive it on Tuesday, and you count Tuesday, Wednesday, Thursday, and you can close on Friday. So what this means is that files are going to take or have to be ready 7 to 10 days prior to closing. Now, remember, Sundays don't count in counting the 3-day rule for the CD, and the right of rescission stays in place. So the right of rescission is not affected at all by this rule. But again, files have to be ready 7 to 10 days prior to closing, and that means that last-minute requests for changes to the forms, last-minute changes to move up the closing date will be more difficult.
So Don, just to really put a wrap on this and kind of simplify it, if I'm a realtor today, this could really affect the date that my buyers or sellers want to close on.
It really could, because keep in mind, if there's any changes at all, the settlement agent has to immediately contact the lender and wait for the lender to tell them how to proceed. And it could require, an additional redisclosure period.
Great. So what if there's more than one consumer involved?
So in rescindable transactions, every consumer that has the right to rescind gets the closing disclosure. In non-rescindable transaction, the CD must be provided to any consumer with primary liability on the obligation.
Good. So now I guess the moment of truth comes down. We're at closing, and now what happens if there's a change in the transaction after the closing disclosure has been sent?
Well, the good news is that for most changes, it'll just be a revised disclosure at the closing table. But some changes require another mandatory waiting period. So if there's a change to the annual percentage rate up by 1/8% or 1/4% on some loans, if there's a change in the loan product, for example, the consumer decides to go from an ARM to a fixed rate mortgage, or if there's an addition of a prepayment penalty, that is going to require a revised disclosure and a new mandatory 3-day review period. All other changes simply require revised closing disclosure at the closing table. And again, any changes have to be communicated to the lender by the settlement agent once the settlement agent learns of those changes.
Good. Okay. So backing up in the transaction a little bit, what about those hikes and fees that happened years ago between what's now going to be called the loan estimate and the closing disclosure, and this whole concept of variances? How does that actually fit in?
That's a great question, Marvin. So generally, good faith under the rule requires the closing costs on the loan estimate to be equal to the final closing amounts charged on the closing disclosure. Now, there are some variances allowed. We knew them as tolerances under the 2010 RESPA rule, but they're now called variances. And there's now the categories where there's no variation allowed. We call those the zero tolerance or zero variation bucket. You've got categories where limited increases are allowed up to an aggregate of 10%. And you also have some variations that are permitted as long as the consumer is given the best information reasonably available. So what that means is if the lender knows that something has changed, that's what they must charge the consumer. So we have a heightened good faith standard, really a greater faith standard with regard to estimates.
Okay, great. So do changed circumstances still exist?
So changed circumstances do still exist, but again, good faith for the purposes of variations and changed circumstances are much tighter than they were under the 2010 changes. So if there's a changed circumstance that causes a change or change in the aggregate charges to the consumer, or the borrower has some eligibility to change, or makes a decision to change, then the creditor has to provide the loan estimate within 3 days of receiving the information establishing the reason for the revision. Now, the creditor can deliver a revised loan estimate, cannot deliver a revised loan estimate on the same day as delivery as the closing disclosure. And once the closing disclosure has gone out, no more loan estimate. All changes have to be made on the closing disclosure.
Right. Great information. So today, many providers add a cushion for costs on the HUD-1 provided at signing to deal with items that can vary between the signing and when the transaction is settled after recording. The overage is then refunded after the final disbursements are made. Makes it easy for everyone. Will that still be permitted?
Well, again, we've got a heightened good faith standard under the rules, so that will not be permitted. It's more rigorous good faith effort on the part of both the lender and the settlement agent to ensure that you have the most accurate information and that is what is provided to the consumer on the loan estimate and the closing disclosure form. So it's not like today where when there are changes, the lender just issues another good faith and maybe you've got 3 or 4 good faith estimates. Once the closing disclosure goes out, or once the closing disclosure goes out, no more loan estimate, changes on the CD only, and much tighter tolerances. So doing changes like we do today is really not going to be an option.
So that's great information. Now, Bob, what happens if the buyer's in their home, the closing happened, but the CD or closing disclosure becomes inaccurate after the closing?
Good question, and that does happen in our industry. Any changes that are related to an event connection with settlement must be redisclosed within 30 days after learning the event occurred. Clerical errors must be redisclosed within 60 days after closing. Good faith analysis refund variations, formerly referred to as tolerance violations, must be refunded and redisclosed within 60 days after closing. So buyers and sellers can expect to receive 1 or more revisions to CD before and after the closing. Your client may ask you questions about this and what is going on, especially post-closing. Under TRID, post-closing means a longer file life.
So all of this is going to bring out a lot more integration of technology systems and collaboration between the lender and the settlement agent. Really, that's going to be the key to successful closings after October 3rd. TRID is far more than a new set of disclosures, and it impacts both workflow and systems. So technology will support some of the new changes, but this is really the first time that settlement agents will have to contact the lender about any change being made in the process. So there's the new 3 business day rule, which means lenders will need fees within 7 to 10 days of closing, and this all needs to be orchestrated in a much more close way than it is today. So it's very important for realtors to understand that and communicate that with their clients to set expectations. So, Bob, how do you see this integration and collaboration being affecting the title segment?
Well, it will bring about some changes and variations to the way we do business today. Your title company is still going to handle the transaction, as we mentioned earlier. It will still open escrows for the earnest money contracts and processes your transaction through funding and title policy production, the end result. The title company will still be working up the figures in their system since they have to do the actual disbursement of all the funds through the transaction. In addition, the title company will be supplying all non-loan fee information to the lender for completion of the closing disclosure. And then the title company will supply the lender with figures for the title premium, tax and homeowners association prorations, realtor commissions, third-party fees, and seller payoffs. In addition, any invoices, etc., like they do today. Many lenders are stating they will require final figures from the title company 10 days to 2 weeks prior to closing. So last-minute adjustments for realtors, builders' last-minute changes, change order requests, and builder last-minute requests for next-day closings will have to be addressed before the last minute, as they could delay the closing.
So basically, nothing gets put off until the last minute anymore.
No longer. We're not
Right.
in that world anymore.
Good. So, Dawn, as we wrap up, any final thoughts?
Well, just keep in mind that your clients are going to have questions. They're going to ask about the new forms and the timing requirements. So just make sure you're familiar with the new forms, the new timing requirements, and what the rule requires so that you can help answer those questions.
Great. Bob, how about you? Any final thoughts?
You know, I have to echo what Dawn said. It truly is a different business after October 3rd in the sense that we have new disclosures, as we discussed. We have new processes, procedures. And I have to say, communication is truly key to a successful closing, especially at the onset of the rule when we're understanding what the changes will bring to our industry and how we need to adjust the way we do business.
Great. Dawn, Bob, thanks so much. And thank you for watching. We hope all your closings are successful and smooth after October 3rd.